Greetings. It's another Thursday and late morning in Atlanta time, and we're back with another topic, another speaker, another interesting session, informative educational session that we hold with our fellow educators, business community members, and societal members as well. Welcome, everybody. If you are joining us for the first time, a special welcome to you. Some of you who've been with us in past webinars know that we've started these informative webinar sessions in April of 2020, discussed pedagogy, teaching issues, certainly lots of research topics, as well as held conversations with gifted business educators and business practitioners. We come to you from the MSI consortium. This is a consortium of 10 CIBERs led by Georgia State University CIBER. You've seen some of the other CIBERs on the slides that ran in front of you just a moment ago. This has become a tradition now into our third year of offering these sessions free to the educational community. CIBERs, if you don't know, if you have not heard, they're centers of excellence in international business designated by the US Department of Education and partially funded by them and by the partner universities. These webinars are recorded. Everybody who has participated in the webinar will get an email with the recording, so you can share the recording with your colleagues, with your network, as well as have the opportunity to view it again. When you exit the session at the end of an hour, there will be a short survey with just 5 questions. We do appreciate your responses to those questions, one of which deals with your suggestions for future topics. For your information, everyone except the panelists is muted in the webinar. I would like you to use the Q&A for your questions and chat for technical questions with our gifted staff members. I will monitor the chat and Q&A buttons and look at your comments and questions and bring them up for discussion later on. So let's get going with today's topic. I'd like to welcome Professor Farooq Contractor. I think many of you in the AIB community know him. Certainly, he is our current president of the Academy of International Business. Farooq, of course, is a distinguished professor at Rutgers University. He is an established scholar with almost a dozen books, 150 plus some articles. Farooq, as I recall, you have your PhD degree from Wharton Business School. You have engineering degrees from Michigan and Bombay. Your research has covered a lot of ground in IB, alliances, emerging markets, outsourcing, technology transfer, and so on. And your work has been recognized by the JIBS, Journal of International Business Studies. You've been a Fulbright Fellow. You taught in many different countries. You have your own blog, I know, which is well attended, where you discuss international business education and practice issues. So welcome, Farooq, and I really appreciate your time, and I know you are coming to us from a different and not so convenient time framework. I think it's about 9 p.m. where Farooq is now. So special thanks for that. Farooq, I actually have been looking forward to this session myself because, as I recall, your paper in the Rutgers Business Review, which is 2016, it still has relevance. It's never going to lose relevance anyway. But when I saw that piece for the first time, I was really encouraged and certainly made it a part of my teaching with undergraduate or graduate students, is it discusses something we don't normally discuss, in international business. In general, there's an absence of multinational business finance issues, especially tax and accounting issues in our teaching of introductory courses in IB or even more specialized courses in international business. So the paper 2016 in Rutgers Business Review covered the what you call the tax avoidance practices of multinationals. And it was a new topic for the literature, practical as well as academic literature. So I had the idea to feature this discussion since then. I'm glad we're able to do this today. Let me just get going by asking you what initially motivated you to share your insights on this issue, which is of interest not only to educators, but to practitioners, because it deals with tax practices of multinational business companies. What was the initial instigation, Farooq, for your paper?
Thank you, Tamer, for your kind invitation. I'm going to show a few slides. First of all, before I respond to why I was motivated to dig into this topic, I thought I might just show the magnitude of the phenomenon. And I won't spend too much time on these slides, but the takeaway from this one is simply that countries vary significantly in their effective corporate income tax rates, although these are statutory, which means, I guess, the maximum. And the second takeaway is you can notice that from 2000 to 2020, pretty much all countries have dialed back on their corporate tax rates. So there seems to be, according to some critics, a race to the bottom in terms of attracting foreign direct investment. And there are, as I will discuss, tax havens where the corporate tax rate is more or less zero or near zero. And here are the 10 biggest culprits. Okay, let me say a few things about why I was motivated to do this. I began my career before I was an academic at a company called Tata International. Tata is a big conglomerate in India. And we were launching a new project in exporting finished leather garments to Europe. But we had no technology. The group, although it's one of the biggest in India, had no technology in that particular product area. And somehow we got together an equipment list, an assembly line for the factory. And let's say that came to, I'm making up a number, $20 million. But the sum of equipment does not necessarily translate into a production capability because that requires know-how, understanding of quality, understanding of markets, and so on, and what we academics call tacit knowledge. A German company came along and offered a turnkey project where they would just put in the equipment, do the assembly line, give us 6 months worth of training, and let's say that was 36 million. So then I asked myself, what explains the difference between the 36 million turnkey project offer and the 20 million for the machinery alone, meaning a difference of $16 million extra? Well, the answer is tacit knowledge, technology, skills, quality control, understanding European marketing standards, all of which are intangibles. So we're in a modern world where more and more value is in intangible assets and knowledge. That then led me to a dissertation at the Wharton School for my PhD. That my dissertation covered the pricing of technology in international technology transfers. So the fundamental question before our time, and it's increasing in importance and complexity, is how do you value a bundle of both tangible and intangible assets? Because modern items are not a commodity. It's not like corn or oil that you can price as a commodity. Even physical products include both tangible and intangible value. For example, an iPhone that retails for $700 Components flow from 14 different countries to a Chinese assembly operation run by Foxconn. And Foxconn then assembles the phone and invoices Apple at, let's say, $279. But then what explains the difference between the $700 retail price and the $279 export invoice value? And the answer is R&D in Cupertino, marketing overhead, supply chain orchestration, and other overheads at Apple's headquarters. So in short, we're in a knowledge economy where what we're paying for more and more is taught, design, etc., for which there is no easy market value that we can assign. And this is what the economists call market failure. So within a multinational corporation, the company can decide whatever value it wants to assign to a product or a service. Tamer, your next question is going to be. Oh, by the way, I should mention that I did a few consulting projects and expert testimony covering somewhat of this area. I'll mention that later.
Right. Let me just make some comments before we move on. Farooq, you live in a state with a lot of pharmaceutical companies doing production and R&D and so on. Mm-hmm. When we look at their export activities, though, it doesn't necessarily generate out of the United States. I mean, most pharmaceuticals don't necessarily export outside from the United States, but they use bases such as in Ireland. I mean, in fact, there's a huge group of pharma companies based in Ireland, not necessarily doing R&D there, but they're doing a lot of production and exporting. So I guess availability of these tax havens is one big reason why these tax avoidance practices endure, as well as taxation differences that you showed in your very first slide there. There's still, even though the trend is downwards in terms of corporate taxes, there's still a lot of variations from one country to another, which then allows the multinational companies to leverage these differences. Mm-hmm. Is that right? What do you see in your own state with the pharmaceuticals? Do you have any more observations on that?
Yeah, I have one slide and discussion about the role that Ireland continues to play in the tax avoidance game a little later. And in fact, many typical American companies follow the practice of doing the R&D in the US, but the production for tax avoidance reason is in Ireland. And the intellectual property rights, the patents, are transferred to Bermuda or a tax haven like that. So I will explain that a little later.
So each link in the sense in the global supply chain takes place, each value-added activity takes place in a different country. In fact, in a country which is more advantageous from a tax point of view. That brings us to the next question, Farooq. Why these international tax issues are important to managers, to corporations, and academics. And I know you're going to share some resources for us to incorporate these topics into our teaching, which is lacking even in textbooks. But to the corporate world, what does it mean? Do you have some figures on that or indication of how important the savings may be to a multinational leveraging these tax differences and taking advantage of tax havens?
Yes, I have some numbers. I'll dig them up. Global tax evasion and avoidance, according to the UN University and the OECD, is something like $427 billion a year that should be going to governments theoretically, but does not. According to the OECD, the number is a little lower, is between something like 240 billion in lost revenue annually. And by the way, if we include tariffs and there is a lot of tariff avoidance, which I hope you and our academics are teaching in international marketing courses, then that would at least double that figure. But what is the implication for managers? Well, you cannot run a business these days unless you're looking at after-tax considerations, which are fundamental to all calculations and corporate planning in finance or strategy. And managers will tell us that it's their fiduciary duty to maximize value to shareholders by minimizing tax payments. So I remember, for example, even the CEOs are exercised about this. Tim Cook of Apple gave a testimony before Congress several years ago, where he railed against the maximum tax rate in the US, which at that time was 35%. But the irony is that that same year, Apple paid only 2-something% on its global profits. So I'm making a distinction between the statutory or maximum tax rate in countries and through the maneuvers that I will describe, how corporations reduce it to not zero, but fairly low percentages of their income. For academics, this is one of the most under-researched areas of international business, despite being so important. And why is it under-researched? Because most corporate information is proprietary. Corporations have no incentive to share their accounts in detail, especially at a subsidiary level. In most nations, tax codes are arcane. For example, the US tax code runs into thousands of pages. Governments also keep changing their tax codes. It's all extraordinarily complex. But with great complexity, I tell my students that there is research potential and also a career. If MBA students want to get into a McMansion and a Mercedes, I say go into this arcane subject called international tax accounting, and taken that advice and are doing very well in the KPMGs and the Ernst & Youngs of the world. And also government bureaucrats need to understand, because I think right now multinationals are running circles around them.
So it matters. It matters to the corporations. It matters to the government. It matters to the society and taxpayers in general. I remember every time there's an election, this part of this becomes a campaign issue, in the sense that if multinationals are targeted and accused of being runaway corporations, using these tax havens and minimizing their tax obligations at home, they become an easy target for politicians, both local, the indigenous multinationals, as well as foreign multinationals doing business in the United States. Mm-hmm. I know, Farooq, you did a lot of research and worked with practitioners to lead to these findings. You may want to say a few things about that. But I guess whenever you're ready, you can kind of give us an overview of these tax avoidance practices, and then we'll discuss their ethical and legal considerations later. Okay. Because the bulk of the article is about various ways. I think you had about almost a dozen or so practices that you have identified, and it is the only paper that I've seen that discusses these practices in a very comprehensive way. And Farooq's writing is very clear, very understandable for the undergraduate student as well. So it should become. We will mail that article, Rutgers Business Review article, to everybody who participated today, but it's online available. Tax avoidance practices of multinationals, published initially in 2016, Rutgers Business Review. So go ahead, Farooq.
And it's also on my blog. A copy is on my blog, globalbusiness.blog. I mean, it's as simple as that. You put my name in and globalbusiness.blog. So anyway, one of the other motivations was that I did a consulting expert testimony kind of project for a company that's been recently in the news, one of the big IT companies. And the particular issue that I was looking at is whether it's an American company or an Irish company, as Tamer mentioned earlier. Because one of the easiest, simplest way of avoiding international taxes is to simply relocate the corporate headquarters to another country like Ireland and say that we're no more an American company. And Irish taxes are in the range of 10 to 12.5%. And that is a process known as inversions. Now, of course, having said that, the US government has been clamping down on that practice. There's actually tax penalties for doing that. And also from the point of view of the public, it looks unpatriotic to say we're no longer an American company. It's easy in the sense that all you have to do is to shift your legal domicile to another country. Board of directors meet over there. Maybe top management goes there, but operations and the actual, supply chain, et cetera, doesn't necessarily have to change. Okay, let me go and look at some other methods. Before that, I just want to say that it's not just Europe and the United States. You also have China engaging in this practice. So I won't say very much about this slide. You can read about it on your own. But in a few years ago, or several years ago, as much as 72% of outbound FDI going out of China went either to Hong Kong or to Caribbean tax havens. And that is part of the story of round tripping of money going from mainland China to Hong Kong and then coming back as foreign direct investment. Let me leave it at that and go to this method called export-import invoicing in global supply chains. And I won't bore you with the numbers. I'll just give you an overview of what's happening. The company is in 2 countries for A and B. And you can see the difference in the tax rates in this simple example. And the invoicing per unit of export used to be $1,300, later changed to $1,800. And that one keystroke, changing number 3 to number 8, has resulted in lower taxes in company B, in country B, although yes, higher taxes in country A, but the overall result, A plus B, is an increase in after-tax profit from $2,250 to $2,325. And who decides the value of the export-import? Well, it's the multinational company. The very surprising statistic is in 2 parts. First of all, according to the UN and the World Bank, in global exports, meaning exports of all countries put together, a multinational company is either an exporter or an importer in more than 2/3 of shipments. And what's even more remarkable is, according to some estimates, the same multinational company is both exporter and importer in something approaching 40% of world trade. And world trade, meaning the cumulative exports of all countries, is in the range of $23 trillion. So you can do the math and see how multinational companies are not just FDI investors, they're very much orchestrators and participants in export imports. Let me go to the next. I should have pressed the button. Who declares the value? Well, internally within the multinational company. The second method has to deal with international licensing of technology. So very quickly, on the left-hand side, we have scenario 1, where there's a Japanese multinational with a US subsidiary. And on the left-hand column, no royalties. So the ordinary costs of $700, sales of $1,000, and US tax at, let's say, 30% is $90, and therefore profit after US tax is $210. On the right-hand column, let's say that the Japanese parent makes its own American subsidiary a licensee at 5% royalty on sales, which means that the profit on profit before tax, which used to be 300, declines to 250 because they're paying an extra 50 to their own parent company in Japan. So profit after US tax also then declines. I'm sorry, the tax liability declines from $90 to $75 legally. And it goes without saying, I should have said this earlier, that when we use the phrase international tax avoidance, we're talking about legal behavior, but just on the right side of legality. And so that as far as the Japanese parent is concerned, the profit after US tax, yes, it declines from 210 to 175. But in addition, there's that second channel of remittance to Japan, which is 50, so that the total remittance to the Japanese parent is 225 instead of 210. So the use of royalty rates or licensing agreements or contractual alliances, even between related parties, is another method. And who decides the royalty rate? Once again, it's an internal decision. Let me give you another example or a variation on this idea. I think Tamer mentioned the pharmaceutical industry. And I should add that this maneuver in the next two slides is not just in the pharmaceutical industry, but also throughout the high-tech industry, meaning IT, services, et cetera, et cetera. So this is an actual case of a drug called Lexapro, whose R&D costs, I don't know, billion something dollars. It was done in the US, and you would think that, I think this is a mental health drug. So the US is also the biggest market for mental health. It's an American company called Forest Labs. They did the R&D in the US, so you would think that they would produce and sell in the US, but no, their Dublin or Irish subsidiary produces the pills. That's point number one. And those pills are then exported from Ireland back to the parent company in the US for sale at a certain internal transfer price that is decided, of course, by the company itself. But that's not enough. That itself would save a lot of money because, as I said, Irish taxes are between 10 and 12.5% compared to the US maximum of 21%. But that's not all. The companies go much further. And this is typical of everybody from Apple to Google to Pfizer to all these pharmaceutical companies. They shift the patent rights to Bermuda headquarters. They create a headquarters in Bermuda. They say that's our headquarters, and we're transferring the patent rights to Bermuda, and makes Bermuda the licensor to the Irish production facility. To Bermuda, and with a large enough royalty, that's another way of sucking away money to Bermuda, where the corporate tax rate is sort of zero. I mean, there are fees and lawyers and so on, but it's more or less a shell company. So these maneuvers, in effect, take taxable profits away from the United States, where drug prices are the highest in the world, to not only Ireland, where tax rates max out at 10.3 or 12%, but go all the way to Bermuda, where corporate tax rates are zero. Here's a graphic that might be of interest, going more recently to June 2019. You can see that there's an increasing trend on the part of US companies to import from what they call the big three tax havens, which are Ireland, Switzerland, and Singapore. There's another technique called intracorporate loan interest rates. So let's say an American company has a German subsidiary. The American company goes to a bank and borrows money at 6% interest per annum, but loans the funds to its German subsidiary at 3%. So obviously the American operation is losing money, but the German affiliate's local borrowing costs being 5%, they benefit because 3% is lower than 5%. So in short, there's an increase in the net pre-tax cost in the US and a net pre-tax gain in Germany through this simple maneuver. And this, of course, makes sense only if the effective corporate tax for that year is higher in the US than in the German subsidiary. Or take the reverse case example. American company goes to a bank and borrows money at 2%, let's say, but loans the funds to its German subsidiary at 6%. So obviously, extra profits are being made in the US. And if the German affiliate's local borrowing costs are 5%, and they're paying 6%, then obviously there's a net extra pre-tax cost in Germany. And that makes sense if that year the effective US corporate tax is lower than in the German subsidiary. Though there's yet another method, which is the allocation of central headquarters overheads to foreign subsidiaries. You know, in a modern knowledge-intensive, R&D-intensive world, we still have a situation where much of the, or most of the R&D expenditures and other overheads are incurred in the headquarters of the MNC, the multinational corporation. And then logically, slices of that central overhead have to be like a pizza, has to be cut, and slices allocated as a charge, overhead charge to foreign subsidiaries. And of course, depending on whether the slice of pizza is thick or thin, you know, thinly cut, will obviously affect the taxable profits in the foreign subsidiaries or affiliates.
Farooq, let's pause there for a second.
Yeah. Okay.
And elaborate, and before you continue with other techniques,
okay,
you call them, and there's also a question here, comment. So we're basically talking about, in terms of our audience, intra-corporate transfers, intra-corporate pricing, and transactions, which are available to multinationals. In a sense, it is the multinationals that are benefiting from this, you know, compared to firms that are doing business purely at home. Isn't it interesting that they don't have the advantages, such flexibility? And because multinationals, by definition, they operate in more than one country, they can minimize their tax obligations, and these amount to a considerable sum when we take into account all of these techniques. Maria Luisa is one of our participants, and she's also asking, do we also need to take into account, Farooq, government tax credits or incentives, which further complicate? So we're talking about you know, price differences, differences in credit for a cost of money, and you mentioned tariffs. These are all exacerbating factors, aren't they? Government tax credits, incentives, whether it's a credit or incentive or disincentive, to what extent do they play a role as well?
Yeah, remember that. Thank you, Tamer, for an excellent question. I use the term effective tax rates, corporate tax rates. And when I say effective, there is a zillion loopholes and deductions and tariffs and local taxes and you know, carryover of R&D amortization, et cetera, et cetera. So corporations have to assess their effective corporate tax rate in a particular country and in their affiliate country, and then decide whether to increase or decrease the transfer price for their export or their intracorporate loan interest rate, et cetera. And as I said, the US tax code runs into literally thousands of pages, which is why the subject is so arcane. But with the digitization, effective digitization, now companies can sort of, within a few hours, summon up the algorithm or the computer system to say, for a particular operation or a particular country, what is the effective corporate tax rate, and then decide on the value accordingly. Now, by the way, when I mention all these methods and techniques, as I call them, of international tax avoidance, I am by no means endorsing or applauding these techniques, but it just so happens that companies are doing this. And it's sort of sad that companies are even writing algorithms to figure out what value they will put on the export or the...
Yeah, it is a widely practiced convention, let's put it that way. And we'll talk about ethical and legal considerations as well. But before we do that, we may want to give you a chance to complete and mention the other techniques, the other tax avoidance practices. And again, we're just what Parag is trying to do here is to just explain what happens. And I really like your suggestions to our students to specialize in this area. It will make a good career, I think, if somebody takes an interest in, intra-corporate transfers and tax regulations of multinationals.
Right, and it's a topic that is actually growing by the year in importance, because as we will see later, I'll mention this, governments are now getting together to exchange data on corporations, forcing, in fact, if it works, this is still as a proposal, but if it works, companies might be forced to finally divulge not only their consolidated balance sheet and income statement, but subsidiary or affiliate by affiliate. And then that data would be shared across governments for an approach to what is called unitary tax regimes. But I just wanted to show one more slide, which is this one, which is that countries also have different approaches in how much tax they draw from capital versus labor versus purchases. The consumption, I think, means sales tax. And if we look at the right-hand column, we are saying that the US is a rather anomalous country in terms of drawing most of its tax. Now, this isn't just corporate income tax. This is all tax put together from property taxes. But another big takeaway is that despite all the stuff talked about by politicians, the US overall tax collection, whether it's property or capital gains or corporate or individual taxes, it's below the OECD average. So the US is by no means a high tax country in terms of the OECD. In terms of scrutiny by governments, shall I go to that topic?
Please, yeah.
Okay, there's relatively little so far. Each year, multinationals and their affiliates, I ask myself the question, how many multinational companies are there and how many affiliates are there? My educated guess is that we're talking about between 1.3 and 1.5 million. Each of them filed a tax return, at least to the local government. How many tax inspectors are there? In all governments put together, maybe only a few thousand. So the chance that a tax filing will be read by a human being is vanishingly slim. And only a few governments so far have the artificial intelligence or statistical tools. And even those only catch the egregious outliers. I didn't know we had time to talk about this, but if you go back to the example on the royalty rate, which in my example was 5% paid by the American subsidiary to its Japanese parent. Well, what if the royalty rate was 8%? What if it was 11%? The higher the royalty rate in that example, the lower the tax liability legally payable to the US government. But when I say egregious outliers, what am I talking about? If the royalty rate was, let's say, listed as 23%, then the AI or the program, the IT program would pick up that filing, I should say, as an egregious outlier, and then a human being would read it for the first time and question the company and ask them to justify the royalty rate, whatever it might be. And it goes without saying, I think many of us know that the first thing that happens when there's an audit or a questioning is both the government and the multinational try and search for a so-called arm's length or unrelated party benchmark. But the trouble is, in the modern world where products are, if not unique, highly differentiated, and where much of export imports are not in finished products, but in semi-finished products, who on earth can say what is the appropriate value of that shipment? Or who can say that 5% royalty payment for the Japanese technology is reasonable, but 8% is not reasonable? You know, I wish that there was a academic paper. There can't be, by the way, but I wish there was, in theory, a paper or a formula that can tell managers, okay, crunch the numbers and say what is a reasonable or acceptable royalty rate. Unfortunately, there is no such possibility. So it's impossible to allocate an accurate value to knowledge embedded in products and services in the modern world. And most multinationals get away with it. Okay.
So very, very interesting, Farooq. One problem that you have identified in terms of scrutinizing these transactions, these practices, it's very difficult, almost impossible for governments to do that. It just goes beyond their resources. Even, I guess, most well-prepared or highly sophisticated, let's say, tax regulations and tax authorities. So that's a big problem. And the other thing is the issue of fairness that you talked about. What is fair price in terms of intra-corporate price transfers? Or what is the fair valuation of technology that is transferred and so on? And that is a subjective issue, right? It's very difficult, and therefore it falls in the gray area. When you look at these practices, Farooq, that we discussed today, do you see major differences among countries in terms of both their prevalence of multinationals, let's say from China to Germany to the United States, as well as the way they are treated by regulations of their respective countries? Do we see any patterns there, or is it something that is across the board, regardless of ownership, nationality, and regardless of size and all that?
Well, the desire and the tendency to avoid tax payments or payments to governments with a tax tariff or whatever is universal. It's just that big multinationals are now with the army of lawyers, the army of accountants, and our MBA students joining these careers. They're better equipped to take advantage of it in the big multinationals of Europe and the United States, North America, etc.
Right, and
I don't think there's any difference in that desire or behavior.
As you say, the desire, the objective to minimize tax applications is universal.
Right, but the capability is greater in the big multinationals.
Yeah. This may have been one of the comments, perhaps, that I see. It wasn't as clear, but do you see at least a difference between privately owned versus publicly owned companies in engaging these practices? Have you encountered lesser tendency among privately owned conglomerates to seek such practices as opposed to publicly owned?
I haven't investigated that question.
Okay. Yeah,
but it seems to me that big public corporations are, as we know from news reports and as I will say, are increasingly coming under greater scrutiny, at least by the major governments like US, China, and Europe. Whereas private companies, especially if they're middle size or Mittel Europa or small, they might get away with more of these practices. That's just an educated response.
Great, great, thank you. One of our participants, Sadok Gol, is sharing some resource. OECD has some statistics on tax enforcement. And thank you for giving Sadok the link to that for our participants. Everybody can see that. There's another question from Mona Bal. Do you think the proposal by Secretary Janet Yellen to global leaders to cap the corporate tax rate, if it's approved, will it be accepted and implemented by tax haven countries?
Yeah, it's not a cap, it's a minimum. The proposal before the OECD, and right now being negotiated by more than 140 countries, is a minimum tax of 15%. And, in the US Congress itself, there's significant opposition. So we don't know where this will go in terms of the negotiations within the OECD itself, and then how many governments in their own legislatures will ratify that idea. But I'll talk more about that in a moment.
Okay. One more question, I guess the comment, the role of the international accounting firms. In a sense, multinationals themselves are engaging in these practices in collaboration with their accounting firms, right? I mean, so kind of responsibility is shared between the firm itself as well as the accounting firms. Do you see because these independent international accounting firms are involved, there will be more scrutiny or openness about these practices?
No, not necessarily. On the contrary, the big accounting firms are writing the IT programs for companies to try and extract from their subsidiary and headquarters accounts tax avoidance, tax minimization techniques and opportunities.
Right.
So, I mean, I feel conflicted as a professor. On the one hand, I'm telling my students, here's a big career opportunity for you. But then I know what's going on. At the same time, governments are beginning to take notice. 10 years ago, there was much less awareness, let alone scrutiny by governments on this issue. And now governments are waking up and trying to coordinate and under the OECD umbrella, negotiate some kind of data exchanges have already begun on a bilateral treaty basis.
Farooq, so you identified regulations as potential inhibitor or mitigator of such practices to the extent that multinationals observe them. What about societal responses and critiques, global citizenship, accountability issues? I mean, so in recent years,
considerations.
Multinational companies have been under the radar from the society in general, various citizenship groups. Do you think that's going to be a potential factor in this practice? And you have some comments on that. I'll let you speak to that.
Well, obviously, we know as academics and as readers of the business press that there's now greater sensitivity towards the ESG and governance of corporations. Now, here's how I look at it. When a company makes profits, there are 5 claimants. Government wants to collect a piece of the profits. Then shareholders, management, meaning top management paying itself bonuses, workers, and society. And one you might argue is an exogenous variable, but actually it can be manipulated. In the US, there's, for example, this shameless practice where a company or an industry association will actually draft a bill or legislation, hand it over to the staffers of a senator or congressperson and say, pass this as legislation. So on the one hand, where do these thousands of loopholes come from? They come from lobbyists who actually, in some cases, write a draft of the proposed legislation or loophole to be passed by Congress. Anyway, the distribution of after-tax profits accruing to categories 2, 3, 4, and 5 is indeterminate. And who decides that? That's an internal decision made by upper management, which, especially in the last 20 years, has been paying itself more and more salaries and bonuses, and also shareholders' profits go up, but to the detriment of the share of the pie captured by workers and society. And the underlying root cause of all this, including another phenomenon which we don't have time to talk about, which is offshoring and outsourcing and automation, is of greater intensity, a brutal degree of competition between firms that has not been seen in past history. And when companies are competing ferociously, then they look to maximize profits in whatever way they can and resort to these international tax avoidance practices.
Excellent, excellent. So you see this tendency that to continue into the future?
Oh, more and more, yes. This is, as I said, about 10 years ago, few governments were awake to this issue. Now they've woken up. And as I said, 140 governments are now negotiating. I'm not sure what will happen from that negotiation because, I mean, the idea is already compromised. I'll mention that within the OECD itself. And then each country's legislature has to pass it. So what will come off it, I don't know. But the fact that 140 plus countries are negotiating suggests that they've woken up. Governments around the world have woken up to this issue of taxes being avoided.
We promised to our participants also some tips and resources for incorporating these issues into our teaching and informing our students. Before we get to that, Farooq, there's a question from James about transparency. Given this societal pressures placed on multinationals and corporate community in general, and their annual statements where they talk about, for example, CSR type of statements, environmental, ESG kinds of reporting. Do you see tax transparency, intra-corporate tax transparency to be part of that annual disclosure, or we don't see that yet?
No, we don't see that yet.
You don't see it, yeah.
But in my article, I make a proposal that decisions in the C-suite and at the top of the finance treasury departments of multinationals is so far dominated by the algorithms, the accountants, the finance experts, and so on. My proposal in the article says each company should appoint a CSR spokesperson or ombudsman, ombudswoman, whatever. And that person should be given a seat at high councils or in the top strategy making body of the company. And the multinational should, this is just a proposal from me, the multinational should publish each year a report saying what have we contributed to each country in which we operate. Now, maybe not all contributions are money, and paying taxes is only one kind of contribution, but maybe a multinational can make other types of contributions. upgrading skills, increasing employment, teaching the rest of the industry better practices. So if that kind of statement each year for each affiliate in each country to say, what have we contributed as a company to the society at large, that would be a very useful thing. And it doesn't have to be just tax contributions, as I said. Could be tax plus other benefits of the presence of the MNC in that country.
Excellent suggestion, and also a research opportunity also. To what extent some of the leading companies are actually becoming more transparent about these intra-corporate transfers. And there's also disclosing such transfers in their annual statements, disclosures, and so on. That would be a welcome change. Maybe we just have a few minutes left. What are your suggestions? I mean, where in the semester and when in the semester do we teach these topics? When is the best time, let's say in a semester, 14-week course or 10-week course? And how do we, what kind of resources, apart from your article, which is excellent read, what kind of resources would you suggest our colleagues to use?
As to what kind of courses should include this topic, I would say for sure, I mean, it's a no-brainer to say that it should be an important component of an international finance course, international corporate finance course also. It should be unquestionably part of accounting program or accounting department offerings. And I would say, if you look at my article, it is so easily digestible. It is, I mean, it's simple examples that illumine and illustrate these techniques. It can even be in an introductory international business course. That's what I do at the MBA level. I mean, it all said and done, it takes an hour and a half to discuss all these issues. And it's very easily picked up in the simple examples that I have in the Rutgers Business Review and the blog article. So I would say, yes, it should be part of an introductory course. I do that. Even in a 2-credit course, I'll spend an hour or hour and 15 minutes talking about this.
I can certainly validate that Farooq's paper, Rutgers Business Review, is very accessible, easy to read by an undergraduate student, and it would be an excellent discussion tool in the classroom as well. If they are assigned, students are assigned that article themselves. So I think it's appropriate to discuss this when the issue of CSR, social accountability, responsibility comes up. It could be discussed. Multinational business finance issues comes up. It can be discussed. That's another place, I think. And it can be even a role-playing exercise for students. So with that, it's our hour is up. I'll have you to offer some final closing comments, Farooq. And I will again appreciate everybody who joined us today. And before everybody logs off, thank you for being here and look forward to seeing you next week at another webinar. And when you do log off, there will be a short survey. Please respond to that. With that, Farooq, some closing thoughts, final comments.
Yeah. Thank you. I mean, one of the issues that comes up is what are the future directions? And we see that governments are increasing data exchanges. And the fact that even in the emerging country in which I'm currently sitting, which is India, there's increased digitalization of tax filings. And therefore, it's easier for the AI program to catch egregious outliers. There's, of course, more intergovernmental cooperation, and we're inching towards a unitary system. What is a unitary system? Which is to treat headquarters and all affiliates of the multinational as one entity, and then find out what value is being added in each affiliate in each nation. And then each nation taxes taxes not according to the profit declared in each affiliate, which can be manipulated as in the past, but according to the value-added share of the multinational company's global activity in each nation. And you can read this on your own. I mean, here's the citation from the OECD. The negotiations are trying to finalize along what they call two pillars, which is a distribution of so-called residual profits to be reallocated to other countries. And pillar two is the proposal to have a global minimum corporate tax rate of 15%. So there I will leave it. I hope that everybody got some insight into this important phenomenon. Thank you so much. And
Thank you, Farman.
be free to send me an email if you wish at the address down below. Thank you, Tamir, for
Thank you
hosting
for your contribution. There's a lot of praise for your comments. Everybody's thankful. You can see that in the chat room as well. So we say thank you for participating in this fascinating discussion today, and look forward to seeing you next week with another interesting topic and speakers. Have a good rest of your day.
Thank you.